At its most basic level, a financial instrument is a contract. It is a legal agreement that simultaneously creates a financial asset for one entity and a financial liability or equity instrument for another. The accounting life cycle for these contracts begins at a precise moment. Entities must recognize these assets and liabilities on their balance sheets the second they become a party to the contractual provisions. Global markets generate an immense variety of bespoke financial contracts, ranging from straightforward corporate bonds to complex multi-layered derivative swaps. This volume creates a high risk of reporting chaos. Comparing the financial health of two different companies requires a rigid taxonomy. Standardized rules force this contractual variety into a transparent structure, ensuring similar instruments are measured and reported using the same logic. The solution to this reporting challenge is an interconnected framework governed by MFRS 9 and MFRS 7. Together, they dictate the complete life cycle of an instrument: recognition, classification, measurement, impairment, and disclosure. We are going to construct the MFRS 9 decision matrix from scratch. This will demonstrate how an instrument's accounting treatment is a strictly logical outcome derived from its inherent characteristics and management-specific intent. This framework is designed to strip away arbitrary accounting choices. By standardizing the math, MFRS 9 and 7 expose the actual economic conditions within corporate balance sheets. This diagram represents the root node of our classification tree. We begin by splitting the entire universe of financial instruments into three categories: debt, equity, and liabilities. Equity instruments follow a strict default rule. Because their returns are inherently tied to market performance, they flow directly to fair value through profit or loss, or FVTPL. There is a single exception for equity. Management can make an irrevocable election at inception to route fair value changes through other comprehensive income, known as FVTOCI. However, this option is unavailable for any instruments held for trading. Shifting to liabilities, the default classification focuses on stability. Most financial liabilities are measured at amortized cost. Liabilities deviate from amortized cost under specific conditions. They must go to FVTPL if they are actively held for trading, or if management chooses to designate them at fair value to eliminate an accounting mismatch. A clear pattern drives this initial split. Anything actively held for trading is routed to FVTPL to expose current market realities, while baseline, long-term operations favor the stability of amortized cost. The debt branch is the most complex routing matrix in the standard, requiring a deeper level of logical deduction. Looking closely at the debt branch, we hit two mandatory gatekeeper tests that govern classification: the SPPI test and the business model test. The SPPI test examines the contract itself. It requires that the instrument's cash flows are solely payments of principal and interest. This separates pure lending arrangements from instruments carrying complex equity or market risks. To reach amortized cost, the debt must pass the SPPI test, and the entity's business model must be strictly to hold to collect those contractual cash flows until maturity. The path to FVTOCI opens when the debt passes SPPI, but the business model is a hybrid. Management intends to hold to collect cash flows, but is also prepared to sell the asset if needed. The catch-all default is straightforward. If a debt instrument fails the SPPI test, or if it is part of a trading portfolio, it defaults directly to FVTPL. For debt, classification is never arbitrary. It is a mathematical outcome based on what the asset actually is, proven by the SPPI test, and what management intends to do with it. Once classified, we move to measurement. All financial instruments are initially measured at fair value, but the treatment of transaction costs follows different paths. For items measured at FVTPL, transaction costs are expensed immediately to profit or loss. In contrast, for instruments at amortized cost and FVTOCI, transaction costs are capitalized. They are added directly to the initial value of an asset or deducted from a liability. Subsequent measurement defines how volatility hits the financial statements. For FVTPL, every fluctuation in fair value creates immediate volatility on the profit or loss statement. For FVTOCI, fair value changes bypass the P&L and are parked in other comprehensive income, preserving operating profit from unrealized market swings. The amortized cost method ignores market fluctuations entirely. It uses the effective interest method to smooth returns over the life of the instrument. The carrying amount for amortized cost equals the opening balance plus the calculated finance income or cost minus the actual cash received or paid. Amortized cost exists to reflect reality. When a company intends to hold an asset to maturity to collect principal and interest, applying fair value would distort the P&L with irrelevant market noise. MFRS 9 replaced the reactive incurred loss model with the proactive expected credit loss, or ECL, framework. As this diagram shows, the ECL shield applies to amortized cost and FVTOCI debt instruments. FVTPL is excluded from the ECL model because Plurigrisk is already integrated into its continuous fair value market adjustments. This forward-looking model operates in two tiers. Assets start with a baseline 12-month ECL. The heavier lifetime ECL is triggered only when there has been a significant increase in credit risk since the asset's initial recognition. Structural anomalies require special handling. A convertible or hybrid bond contains both liability and equity components. As visualized here, the liability component is measured first, at the present value of future principal and interest. The remaining proceeds form the equity component. The final stage of the life cycle is derecognition. Financial assets are removed from the balance sheet when the rights to cash flows expire or transfer. Liabilities are removed only when the obligation is discharged, canceled, or expires. The ECL model and these derecognition rules serve a unified goal. They force entities to recognize financial failure before it happens, ensuring the balance sheet provides a predictive view of an entity's credit position. While MFRS 9 provides the mechanical accounting treatment, those calculations are supplemented by the specific requirements of MFRS 7 disclosure. The primary objective of MFRS 7 is to compel entities to reveal the significance of financial instruments to their overall financial position, performance, and cash flows. Management must reveal to stakeholders the specific qualitative and quantitative risks they are exposed to, namely credit risk, liquidity risk, and market risks, encompassing currency and interest rate fluctuations. MFRS 7 prevents companies from relying solely on technical accounting. It forces them to narrate the specific vulnerabilities and market dependencies their financial instruments create. The architecture of this framework establishes a direct logical flow. It traces a line from management's intent through classification and measurement directly into impairment and disclosure. This chart extracts the core MFRS 9 debt architecture into three exact formulas. 1. Debt passing SPPI, held to collect, equals amortized cost. 2. Debt passing SPPI, held to collect and sell, equals FVTOCI. And 3. Trading items usually equal FVTPL. Financial reporting standards are not arbitrary hurdles. They are instruments of clarity. By combining MFRS 9's rigorous mathematical routing with MFRS 7's requirement for risk transparency, the accounting profession transforms contractual complexity into a verifiable map of corporate reality.